Energy markets play a big role in everyone's lives, whether talking about the price of fuel at the pump or the price to heat people's homes. In this video, we're going to look at some of the opportunities and dynamics of trading in energy markets. When we talk about energy, it actually encompasses a number of different commodities. Perhaps the most famous is the price of crude oil, which can be traded both in the United States and in the United Kingdom. The US price is based primarily on supply and demand in the US market and is sensitive to the US economy. The UK price of crude, better known as the Brent price, tends to be more sensitive to supply and demand in Europe, and therefore is sensitive to changes in the European economy. Traditionally, these two prices traded very close to each other within a couple of dollars. In recent years, however, a wide gap has opened between the two prices because of changing political risk in the Middle East and North Africa. There are also a number of energy commodities that fluctuate on more of a seasonal basis, depending on how demand changes throughout the year. For example, natural gas and heating oil both tend to see a lot of demand in the wintertime because they're used in home heating. On the other hand, in the spring and fall, demand for both of them tends to be fairly low. There is a second pickup for natural gas demand in the summertime as it's used in power plants, and when people run their air conditioners in the summertime, there is higher demand. There are a number of reasons why people look to trading energy. First of all, crude oil has tended in the past to act as a leading indicator of the global economy. When crude oil prices increase, they've been known to also lead to increases in inflation. Rising inflation then forces central banks to have to raise interest rates and slow their economies. A number of recent recessions have been preceded by spikes in energy prices. Traders also look to energy to hedge their exposure in other areas. For example, if you're worried about paying higher prices at the pump, by trading oil or gasoline, you can capture the increases back through your trading. Crude oil, as in other commodities, is not exposed to the same levels of financial risks that are involved when trading stocks. There are a number of factors that influence trading in energy markets. Perhaps the most important, for the longer term especially, is changes in the global economy. As the global economy grows, demand for energy tends to increase. As the global economy contracts, demand for energy tends to contract as well. As we've discussed earlier, seasonality also plays a major role in trading in select energy markets. Finally, and perhaps one of the other most important factors, is political risk. Crude oil in particular is produced in a number of areas that tend to be more politically volatile. Because of this, when tensions rise, concerns also rise over the supply of crude. It's not just production, however, also distribution is important. Shipping of crude oil tends to go through a number of key choke points around the world, and should tensions rise around those, can also have an impact on pricing. Political risk in energy markets is not limited, however, to emerging or more volatile regions. We can also see political risk in North America and other developed countries. In these countries, the risk tends to revolve around permitting, around permission over where and when people can explore for energy, and also for permitting things like refineries and pipelines. There are also specific news announcements that come out over the course of each week and month that also have an impact on trading in energy prices. In particular, weekly inventory data is quite significant. Information on US crude oil and gasoline inventories tends to come out on Wednesday mornings. Natural gas inventories come out on Thursday mornings. In addition, demand forecasts from agencies such as OPEC or the IEA, International Energy Agency, also can impact trading in energy markets. In addition to trading energy commodities, people also have the ability to trade energy stocks, and there are slight differences between the two. First of all, stocks of oil and gas producers, tend to act as a leading indicator for energy commodity prices. Why is this? Because when traders are looking ahead at future earnings for energy producers, implicit in that are forecasts of energy production and also of the energy price. So stocks, therefore, do reflect attitudes towards future energy prices. Trading in specific oil and gas producers can be influenced by a number of factors as well, such as the company's success at exploration, their financial risk, and other factors. Within energy markets, there's also the opportunity for traders to take advantage of what's known as pairs trades. Pairs trading involves going long one instrument and short the other in order to capture relative changes between the two. Some of the better known pairs trades in the energy market, particularly in recent years, has been UK crude versus US crude. In recent years, a wide gap has opened between the two based on changes in political risk. When people feel that political risks are rising in the Middle East and North Africa, UK crude tends to outperform. On the other hand, when political risks decrease, US crude tends to outperform. In addition, over the years, there have been opportunities to trade between crude oil and natural gas. The final one to look at is crude oil versus some of its products. For example, crude oil versus gasoline and heating oil. By trading 1 barrel of crude versus 2 barrels of gasoline and 1 barrel of heating oil is known as the crack spread, and it also is an indicator of margins for refineries.